Hi and welcome. My name is Jennifer Schneider with Key Analytics, and today we're talking about beginning investing, how to select the right investments. First, it starts with preparing for risk. When we say preparing for risk, we're talking about your cash flow and your readiness for unexpected expenses. Do you have enough excess income after your expenses each month to commit to an investment strategy? Get that in order so you can reach your goals. What about a savings account to cover 3 to 6 months of expenses and insurance coverage? What I'm saying is make sure that you are ready for the unexpected. If we aren't prepared, our investment plan gets ruined and it will keep us from reaching our goals. Define those goals. Make them measurable. How long will it take and how much can you save? Get online and use those goal calculators that are available. There are a ton. Your company retirement plan usually has some for you, and so does your bank. Some of the details of your goals will determine the types of investments you choose. Price volatility. Investment returns depend on price changes, and ideally we want those to be going up steadily over time. But from day to day, we can see a wide range of price swings from our investments. It's important to understand what is typical for the investment you may be considering, and if that's acceptable to you. Avoid investments that make you nervous or that you don't understand what makes their prices move in the way they do. Here is a chart that shows two sets of price swings or price volatility over time. One is much more volatile than the other. My point here is to show you the difference between investing in only one security, in this case a stock, that's in blue, and investing in a diversified basket of securities in yellow. Holding a variety of investment types will help you smooth out your ride and allow you to relax a bit about your choices. For beginning investors, we suggest starting with a basket of securities like a mutual fund or ETF. This will give you some diversification and avoid feeling the pressure of selecting the perfect stock. This leads us to the idea of correlations. This fancy statistics word is simply describing how similar two investments move together. Here you can see 1 and 2 move very similar. The degree to which one goes up or down is a little different, but their direction is the same. When one goes up, the other goes up. When the other goes down, when one goes down, the other goes down. During positive markets, this is fine, but what happens when the market begins to provide negative returns? If you only hold 1 and 2, all your money will decrease in value. To avoid this, you could add an investment to your mix that moves differently than 1 and 2. So when the market goes down, something like number 3 might go up or stay steady. This is what creates the smooth ride we saw on the previous slide of the yellow basket of securities. The point here, have a variety of investment types that don't all move in sync with one another. Mix up stocks, bonds, cash, commodities, real estate. Okay, so we believe that mutual funds are great for beginners. Mutual funds can offer a variety of security types that we mentioned. The firm or person that runs a mutual fund or ETF is called an investment manager. Investment managers are considered experts at security selection and will monitor a portfolio of a specified security type for you, and they'll do that for a fee. So let's talk about what to look for in a mutual fund. Here's what you need to know about the basics of mutual funds or ETFs that you're considering for investments. Understand who's making the decisions to buy and sell the securities. Are the decisions made by one person or a team of people? How long have they been working together? It's ideal that the decision makers be with the fund at least 2 years. Avoid funds that change their team too often. This information is available on the fund's website. The assets in the fund. It's my recommendation that you look to make sure the mutual fund or ETF that you're considering has more than $100 million in assets. When you purchase a share of a fund, your money goes into a pool with other share owners. That pool of assets is then invested into a group of securities determined by the fund. The fewer the assets, the more costly operations gets for the fund company. $100 million is a good place to start for reducing costs. Asset inflows and outflows are also a good thing to monitor. If assets are leaving the fund, buyer beware. There is likely a good reason for the outflow, and you must understand why before investing. Inflows are a good sign. A fund can decide to close to new share purchases when the assets reach an optimal level for the fund manager. Philosophy and security selection process. This just means, what does the team believe about the general market, and how are they going to add value with their chosen securities? Funds are required to state the philosophy and security selection process. Avoid funds that change their style too often. Know if the fund manager believes in active or passive style of management. Active management just means that they believe their security analysis can give the fund an opportunity to produce returns better than the overall market. These portfolios tend to have few positions. Passive management means that the fund manager believes we all tend to gravitate to the average, and it's difficult for security selection to add excess return. These managers tend to track a broad market index with lots of securities in their portfolio. And finally, go to the fund manager's website and get their market outlook or newsletter. Understand the thoughts the management team has for the current market environment and what decisions are they making or have they made to participate in positive returns. If a manager isn't good about this type of communication, then make a phone call. Sometimes they're a smaller company and they may not be good about this type of communication, but it's okay to pick up the phone. And we all like to look at performance, right? As an investment analyst, here is how I like to review performance of a mutual fund. The fund should have at least 3 years of history. There are lots and lots of new funds and ETFs coming out, especially ETFs. How will you feel confident about your choice unless the manager has a proven track record of doing what they say they'll do? The returns are the way we can measure that. Look at the calendar year returns, 2016, 2015, 2017. Also, look at the average returns. So we're saying for the last 1 year, what's the average annual return? For the last 5 years, what was the average annual return? Those returns should be compared to something to determine if they're any good, right? So we compare them to a market index like the S&P 500, for example, if we're talking about stocks. And we also like to compare to a peer group. The peer group is simply the competition of the fund, another fund that offers a similar style of investing for the same type of securities. There are online tools that will let you do this. Morningstar or Zacks are great websites that you can use to help you go search for funds for free. They help you compare to peers and an index and help you filter through different criteria. Stay tuned because we're going to offer a little bit more detail on screening funds and these types of tools in the future. Fees. This is a big one. Most investors are completely unaware of who they pay for their investments and how much. When you select your own investments, you may not pay a financial expert for their opinion, but you do pay for the trades and for the mutual fund fees. Before investing in anything, you must know how much it will cost. Or let me say it another way, how much it will take away from your total return. Trust me, everyone gets paid. Well, that was the quick and dirty about beginning investing. You will use this list of action items your whole life, not just at the beginning. Remember the budget and how much excess income you have makes the investment strategy work. Remember your savings and emergency plans with insurance. Protect the investment plan. Will you pick just one security to invest or a basket of securities, as with a mutual fund or ETFs? What mix of security types will you use? When you are starting, you will likely have 2 or 3 security types, but as your assets grow, you will add additional ones. Will you use stocks and bonds, or will you use commodities and real estate, for example? Will you choose passive or active management, or both? Don't feel pressure to pick one or the other. Lots of information out there makes it feel like you have to choose one side or another, but you can absolutely have a mix of passive and active investment styles. Take time to do research and look for the right investment. Use the criteria we talked about to know that you are choosing the right fund. Understand it. Finally, monitor. You must look at your investments 1 to 2 times per year. Things change. There is no set it and forget it that works. You must take an interest in the growth of your assets. Your financial freedom depends on it. No one will care more than you. Replace those investments that are underperforming or something has happened. Use the same criteria we use to find a new fund. Make sure your goals are on track during your review. Revisit those calculators and adjust your savings needs if necessary. That's really the investing process in a nutshell. We will have a detailed course coming up in May 2018 that will go through each of the slides we talked about today in much more detail. The Keys to Personal Finance Association is where we offer courses with a variety of topics. You can check those out at keystopersonalfinance.teachable.com. And for key investment thoughts, check out our blog at kittoday.com. Of course, we're on social media, so stop by and give us a like or share. We'll see you soon.